Bank of America just sent a massive warning to the car market and for the whole U.S. economy. We're about to hit a massive wave of car repossessions from people who paid way too much during the pandemic for all those cars. 1 out of every 20 consumers that have an auto loan right now are over 90 days delinquent. And banks right now are making things worse. 50% of all used car loans that are being written today are being written for over 120% of the value of the actual car. All right, now, so what's going on? Well, Bank of America is actually expanding 84-month loan terms to more borrowers right now. And this is out of necessity because people just can't afford to buy vehicles right now at what we would see as traditional loans like 4, 5, 6 years. It's even crazy to say 6 years, but that's been something that's been the norm for quite a bit now. But now we're expanding all the way to 84 months being a norm here in the car market. And what was it? Because prices on these cars are too high. We're getting consumers that don't have a lot of money, and the only way that these banks can actually write loans for consumers is if the consumers can afford the monthly payments. So here's a crazy stat that's coming from all this. Subprime delinquencies that are 60 plus days past due right now are at 6.9%, right at 7%. And right now, this is worse. These numbers are worse than what we saw back in 2008. And here's the thing. It's way worse than even what these numbers say on here on my little note card. The reason being is because there's two things. We have a lack of repo drivers that are in the system right now. We still have a line, a backup of cars that need to be picked up off the road, but they just can't because they don't have someone to go pick them up. And then two, we have this extend and pretend thing going, especially for a lot of big banks, especially for companies like CarMax and Carvana, where, okay, they need to be repoing these cars, but they don't want to throw out that R word, this repo crisis that's going on right now in the car market. So what do? Well, they work more with their consumers. They say, okay, you know what? If you can't pay it right now, it's fine. Let's just, and they keep just giving them a phone call every month or whatever. The term in banking right now is extend and pretend. Pretend like nothing's wrong. Keep extending the loans. But at some point, the music's got to stop. And at some point, they got to pick up those cars. And we will, on paper, have this repo crisis. And it's much worse right now than this 6.9%. Well, 5.2% of all auto loan debt right now is over 90 days delinquent. That is insane. This should not be happening because once we get to the point where we're past 60 days, that's when these banks have to start picking up these cars, and they're just not doing it. So these numbers right here should tell you that a lot of these banks, they are extending, they are pretending, they're not going to get these cars when they should have to. 5.2% of all auto loan debt over 90 days delinquent. Shouldn't be happening. So right now, with the consumers being so desperate and with all these problems in the car market, we actually have fraud that's running rampant right now in the car market. We have 1.7% of all auto loan applications have some connection to credit washing. And for those of you that don't know what credit washing is, I'll try to explain it here in just a minute. But I know 1.7% doesn't seem like all that much. But if you think that's 1 out of just about every 50 consumers that walk into a car dealership to fill out an application to get a car, they're actively trying to commit fraud in this transaction. So what credit washing is and why it's such a big problem right now is because it's becoming easier and easier and easier to do with the invention of AI. But what consumers can do is if a consumer has a 500 credit score, but they want to go and actually get a loan, if they walk into a brand new Toyota dealership, they have a 500 credit score, they're trying to get a car they can't afford, they're not going to be able to get that loan, right? So what they're able to actually do is dispute things that are on their credit. You think of what would keep a consumer's credit scored down. Well, if they have a repo on there, if they have a credit card delinquency that they're dealing with, if they have a phone bill that they never paid, all these things that hit their credit. Well, what they can do is they can dispute each and every one of those instances that hit their credit, and that has to fall off their credit for a certain time period while the credit bureaus actually investigate the dispute. So why this is important right now and why it's being able to be done in a much higher clip than what it used to is because these consumers that actually want, I call them consumers, they're criminals, that want to actually do this to be able to get into a loan that they shouldn't have, well, they can use AI to spam these disputes across all these credit bureaus to temporarily make these instances disappear off of their credit. So their credit score of 500 overnight can instantly get popped up to like a 750 because all of those repos, all of those credit card delinquencies, all those bills that they hadn't paid, they have now been disputed, so those things fall off their credit for that short amount of time. They go into the dealership looks at their credit. Oh, it's great. You got a 750 credit score. We can get you in this car. And by the time that the credit bureaus actually figure out that these disputes were bogus, they were spam, they were from AI actually helping this consumer be able to take them off of their credit, well, it's too late because that customer is already driving that car, and a lot of these consumers had no intention of actually following through on the payments. So then these dealerships, then these banks are now going to get stuck because they wrote bad loans, but there's no way of them knowing because the credit bureaus are being held up from all of these disputes that have been hidden basically from them being able to report what their actual credit score is. And it's all because of the help of AI, and in desperate times come desperate measures. When something like AI makes it easier for this to happen, well, the bad actors are going to take advantage of that. And that's exactly what's going on right now. That's why auto loan fraud is running rampant through the system right now. The way all these banks make money is by writing loans and get the interest off those loans, right? So if the banks can't write the loans and people can't afford them, then that's less money that the bank can make. So it's obvious that a lot of these banks are going to longer terms so they can actually get people in these vehicles so they can make money off their interest. Loan payments go down. Obviously, that's a good thing for consumers trying to get in cars that really can't afford them anyway. But here's the problem. With accelerated depreciation, especially at the beginning of a loan term for an asset, a liability like a car, what I'm walking in front of right now, well, I can tell you that, okay, this Subaru right here, when it was brand new, it was probably a $45,000, $50,000 vehicle. Now it's $5,000. They go down very, very, very quickly as far as the value that they actually are. So when you have less money that's going to the principal, especially at the front of the loan for a lot of these cars, you have that accelerated depreciation that's also kicking in. Negative equity is going to get worse and worse and worse the longer that these loan terms are extended. And here's another problem. A lot of these cars, they're not going to last the time period that the loan actually exists for. A lot of the cars that are being made now, even the brand new ones, I can't see a world where tons and tons of these vehicles are going to last 7, 8, 9 years like a lot of these banks are trying to get these loans written for. It's going to be a major, major problem going down the road. Whenever these cars start breaking, repos, delinquencies are going to get much, much worse as the quality goes down, as payments go down, as these loans get extended. And something else that's interesting, some numbers that we were able to pull is that in like a 6 or 7 year loan, in that 42-month range is the time period of the highest likelihood that a car is going to go into default and need to be repoed. There's a zone in there, but 42 months is the average of the danger zone. We have to look back about 42 months ago. What was going on? Well, we were at the height of when prices had spiked the most, both on used cars and on new cars. That was the time period where we had lower production, we had chip shortage, we had all these market adjustments that were going on in the system. The example I like to use a lot is like Dodge Chargers and Challengers. So these Chargers and Challengers were sitting on these Dodge lots, and the MSRP on them was $50,000. But you couldn't go buy one for $50,000. Every dealership had a $10,000 and some even $20,000 market adjustment on a lot of these Chargers, these Challengers. And they would pay $70,000 for it, they'd drive it off the lot, and a year later, that Challenger is only worth like $35,000. But they put little to no money down, and they still owed like 65 grand on the thing when it was now worth about $30,000. That actually happened here in this car market, and those same consumers are coming up around that 40 to 42 month range of the danger zone. And here's the thing, they have already experienced all their negative equity. They have it like crazy on those particular vehicles. Not every vehicle was that ridiculous, but all of the ridiculousness that was happening in the car market, all the market adjustments that everyone was paying in the car market, all of those consumers are coming up now on that time frame. We are already at insanely high delinquencies, insanely high repo rates, and now we're entering into the danger zone where it should get a lot worse than what it is right now. So what did we talk about a couple of years ago that was such a big problem coming from these banks? LTV ratios, which is loan to value, was like at 120 to 150% on every single car. So banks were saying, okay, well, prices are high right now, but we'll even loan way over what a car's worth just so we can get you in that loan. The reason why I want to bring that up is because right now, for all used cars right now, the average LTV on a loan is 120%. And this is the thing, it's a setup for disaster when you have banks just letting people who can't afford cars in the first place pay way over value. In a lot of cases, when you buy a car, as soon as you drive it off the lot, you're going to lose a lot of money. That's usually on the new spectrum. But on the used car side, it shouldn't be that bad. But if you have banks that are loaning way over the value of the car, it allows dealers to charge way over the value of the car. Prices can't come down if banks continue to allow dealers to charge over the price. Because here's the thing, all these consumers that buy, they are payment buyers. The only way that they can actually make these purchases is by getting these auto loans. So if the banks stop loaning over the value, then dealers can't charge it. And big banks and big car dealerships know that there's a lot of problems in the system. We have banks that are increasing their loan loss provision. CarMax just in the last quarter, they increased their loan loss provisions. And you're going to see Carvana do something very similar. They know that consumers are making less payments than they need to. They know that consumers are going default on their loans. They see the numbers, just the numbers that we're seeing right now. They're on this little note card. They know more about these numbers than I do. They know more about these numbers than the institutes they're actually reporting them. They can see their own numbers. CarMax knows that their consumers are not paying their bills. So what are they doing? They're planning for all this repo crisis. They're planning for a lot of money that they're going to lose because people not paying their loans. And they're putting their money where their mouth is. What are they doing? They're putting money back because they know that they're going to lose money on people not paying their bills. They know that they're going to lose a lot of money when they go pick up that repo. The thing's absolutely trashed and they can't sell it again. They're going to lose $10,000, $15,000 on that car because it's ripped to shreds after a consumer just has it for 6 months. All right, now, so what does all of this explosion in repos, auto loan delinquencies, negative equity over the last couple of years, what is this going to do to me as a small used car dealer? I sell cars for $5,000 and under. And really my availability of inventory is dependent on a lot of these same kind of consumers that are defaulting on these loans, that are getting all these cars repoed. Well, it can do really two things. One's good, one's bad. The good is probably in a much smaller scale, but it can actually bring more customers to me because what do you have? You have all these consumers that have repos on their credit now. They're in default. They don't have money anymore. They really can't go out and get another big car loan. So what do they have to do? Well, I mean, they can't get this loan, but they, in a lot of cases, can scrape together $2,500, $3,000, $3,500. So these consumers, well, now that they can't get a loan, they can't go to a new franchise dealer and get that brand new car. They're forced to actually come to me and come to buy one of these cars that I have for $3,000 or $3,500. So we can actually increase the amount of the population that actually is going to buy cars and then come to us. But the problem is the amount of inventory that's going to be in the system now because of all this is going to go down. So those same consumers that would go and trade in their car and get a new car loan, but now they can't get a new car loan, well, they're not going to trade in their cars, they're just going to keep them for longer. So that means that inventory that they would trade in. Franchise dealer sends it to auction, and that's where I buy my cars from. Well, now those consumers are just not going to trade in their cars. So a lot of this inventory that I would have gotten, because there were easy loans out there, because these consumers had good enough credit to be able to roll into the next car loan and then be able to trade their other car in, and then I would get it, no longer going to be the case. So inventory, quality inventory, amount of inventory is going to go down for me because banks get tighter because of all these repos and because consumers can't get into the new car loans. But I might still increase a little bit the amount of actual consumers that I can sell to because they just can't get the loans. Good and bad, but I think it's a net negative for my business going forward. And I hope that's not the case, but probably the situation that I'm going to have to deal with over the next 2, 3, 4 years.